Ben Reppond. Today is November 20th, 2024. We're approaching Thanksgiving week next week, and boy, the year has gone fast. I want to do a brief commentary that I did yesterday on the video, and that is that you may, if you look at YouTube videos, and because you're watching this, I'm assuming you must look at others, is that there's a lot of material that I'm reading out there that says the market's going to crash next month, next quarter, next year, etc. Or the dollar is going to crash, or we're going to a digital currency, or whatever, or the economy is going to crash, and housing, etc. And I've been listening to this stuff for a long time, and I hear it over and over again that things are terrible and that they're just about to crash. And you know what? They never do. The people who are saying that, it never happens. Now, do I think the market's going to crash? Absolutely. I don't think it's around the corner. I think it's sometime in our future. It will happen. Maybe I'm wrong. Maybe it will happen in the next quarter. But I've been listening to this for a long time, and I disagree that it is imminent as others are saying it is. And, you know, the dollar, the economy, the market, etc. So all I want to say to you is, and a lot of people who watch this video in particular are investors. They're serious investors. And what I want to say to you is this. Think about how you want to position yourself and what you're willing to endure whenever a crash occurs, whenever it is. It could be right away. It could be down the road, and you're either tactical, like I am, where you move in the market or out of the market. We've been in the market for a long time. It's been good to us. We've done well with that. But it's tactical. There will be a time where we will get out of the market. That's tactical. There are other people who believe that you just stay in the market no matter what, and they write it down and they write it back up, and that's what they believe in. That may include bonds along with equities, or it may just be equities, some combination of those two, or all equities. I don't know. But all I would say is whatever your philosophy is, your methodology is, believe in it, know why you believe in it, don't vary from that. And when the market goes against you, and it will go against every methodology at some point, when it does go against you, be prepared to stay with whatever your belief is, whatever your methodology is. And be careful about listening to all the blah, blah, blah that's on the internet. Okay, let's get into the dashboards. What's interesting here, you see in about the center of the page, the weekly data is all negative, all negative. Bonds are at the bottom, 20-year Treasury. All the equity indexes, the 4 U.S. and the 2 foreign markets, emerging and developed markets, all negative, going from 4% down to 1%. Year to date, however, everything is positive, from 23% on the S&P all the way down to 2% on the developed markets, and of course negative year to date, 8.9% on the bonds. Now, if you are a buy and hold investor, you have stocks and bonds, a lot of people are, then bonds are putting a drag on your portfolio. No surprise, you should know that. So your return is not 15, 20, 25%. Your return, typically, your return is diminished into a very low level rate of return because bonds are putting such a negative drag on your portfolio. Why do Warren Buffett and Stanley Druckenmiller and so many others reject bonds, Jim Rogers, many of them, as a antidote to equity risk? It's a terrible allocation because it doesn't do that much to protect against downside risk, but it does a lot to inhibit upside performance. And this is a typical example of that. To the right of that, you see the red dots and the green dots, and that means above the 20-day moving average if it's green, and below if it's red. So a lot of them are turning red. And no surprise that bonds are, in all time periods, are red. But equities are mixed. Some are positive in some time periods and some are not. When we get over to the sectors, we take the S&P 500, break it apart into its 11 component parts. These are sectors, segments of the economy, and you can see those listed on the left side of the screen. The weekly performance is in the yellow box. The year-to-date is in the pink box. Year-to-date, everything is positive. But in the week, most are negative for the last week. And going from healthcare, now this is interesting, healthcare, a defensive type sector, healthcare negative 5.55%. Wow. And then you go into others like technology, negative 3%, basic materials down 3%, etc. So it's really an interesting mixture of what is positive and what is negative. Year to date, financials up 32%, industrials 22%, consumer discretionary 19%, technology 18%, etc. It's an interesting combination to see. Usually you see technology either at the bottom or at the top. And it's interesting to see it down in fourth place. Okay, so this is the 30-month chart of the S&P 500. So it's a line chart. One move equals one week for 30 months. And most of the time, this has been above its 20-period moving average, still well above the 20-period moving average, even though at the far upper right, you can see the tick down in the line. That's representing last week, and I just showed you that. But still, basically, the trend is upward. When I put this on a candlestick chart, same thing, except you just view it from the candlestick perspective. And the red candlestick down at the end is what I just showed you, that the move is down for the week, but still the black arrow represents the trajectory above the 20-period moving average, moving in an upward direction, in my opinion, well above the 20-period moving average. The relative strength chart of the S&P 500 compared to the NASDAQ 100. NASDAQ 100 is the numerator, S&P is the denominator. So when it moves up, it's favoring the NASDAQ. When it's moving down, it's favoring the S&P. So you can see that in this period of time, there are two arrows I put on there. One to show the upward trajectory over a period of time from the beginning of 2023, almost a 2-year period that has moved up. But I put a red arrow at the end of it to show you that for the last, 4 or 5 months, that it has been moving in a downward trajectory. So it's both. The short term is down, the intermediate term is favorable. The growth segment of the S&P 500, SPY-G, numerator, divided by SPY-V, the denominator, same thing, very similar. Again, not quite as high, but moving in an upward direction over this is a 24-month chart, moving in an upward direction from early 2023 to present, and then the short-term direction moving down, and it's both. It's down short-term and up intermediate term. The S&P 500, which is comprised of large companies, both growth and value, is not as consistent as some of the previous charts, but it emphasizes that the S&P 500 large cap stocks have generally moved up, but in the short run, the last 4 or 5 months, the small cap has come into favor, causing that line to go down. So that says both up and both down. Long-term government bond, TLT, is the ETF. It's the 20-year government bond. As I've said, it's very negative over, this is a 5-year chart, shows you the degree of how negative it is. And again, had a negative week, pulling that number down even further. So there are analysts, there are economists who are saying that interest rates are going to continue to go up. And if interest rates go up, bond yields go up. And if bond yields go up, then the price of bonds goes down. This, again, is bad news for traditional 60-40 buy and hold portfolios. Now, look at the dollar. The US dollar is rocketing up, going up like crazy. So this is good news for those who are spending money in foreign countries and good news for investments in foreign countries. The U.S. economy, the stock market, the dollar, all doing very well relative to other currencies and to other economies and other markets. We'll see some more of this later. Gold, while it has gone up recently, more recently, it has gone down. So this is defensive. So when equities are favorable, which we've seen, sometimes gold goes the other direction. When equities are negative, gold typically will go up. Not 100%, but that's generally a pattern. Silver, even more so. Look at the direction of silver. Still down. As you know, I'm a buyer of, not recently, but I own silver, and I think of buying more precious metals, silver and or gold. And so I don't care if it goes down. I don't care if it goes up. That's not the reason I'm buying it. I'm not buying it for an investment. I'm buying it as an insurance policy against the ultimate collapse of the dollar and maybe even the collapse of the economy. Maybe long term. Maybe I'm wrong. I don't care. I'm glad to have an insurance policy that's backed by something of intrinsic value. Bitcoin, not unlike the dollar, is going up, is rocketing up, and has had another good week. So that's good for Bitcoin. We have a Bitcoin strategy, managed crypto. It has done very well lately, and but it, as you can see, for the, let's see, from about March of last year, or excuse me, this year, March of this year to present, that's about 8 months, it just did this. More losing money than making money. And then all of a sudden it took off. And it's correlated to nothing. Nothing matches it. So, okay, volatility, the volatility index, the VIX, is usually inversely correlated to the equity market, particularly the S&P 500. So as the market goes down, this typically goes up and vice versa. So you can see it's done a lot of up and down, up and down. This last week, you can see it went up a little bit. It's up around 16 right now. Not a big move up. So it tells you that while the market was down, the volatility index did not move up as quickly as you would think it would. I don't know how to read into that, what that means, but that's what it did. Now, we have been in a period with the Asbury 6, the Asbury indicators, 6 of them that were all positive for a period of time. Now they've shifted to be mixed. So there are 3 that are negative, 3 that are positive. Again, that's a reflection of what happened this past week. Asbury does a cross-asset allocation comparison, relative performance, and comparing one class of investments to another. Low volatility stocks for the last week, the last month, the last quarter were more favorable than high volatility stocks. Blue chips, meaning the Dow, were more favorable than the broad market, the S&P 500, and the broad market S&P was more favorable than the NASDAQ. In the bond area at the bottom, government bonds more favorable than corporate bonds, high yield more favorable than corporate bonds, and short-term more favorable than long-term bonds. When we look at the last week, the last month, the last quarter of equity indexes by country, U.S. meaning the surrogate for the U.S. would be the S&P 500. So the last week is the first column, right, or the second column. And the last week, one time the U.S. was more favorable, and that was over Hong Kong. And the only and it was more favorable than the last week, the last month, the last quarter. Singapore, it's interesting, Singapore was more favorable than the U.S. in all 3 categories. The rest of them were mixed. Now, for the past several weeks, maybe even a couple of months, I've been showing you South Korea related to the U.S. They have been the most consistent, where it has shown the U.S. to be more favorable than South Korea. You can see it on the chart on a relative strength basis. So the U.S. would be the numerator, South Korea denominator, and it's gone along, stayed above, most of the time above the moving average, 20-period moving average. And then all of a sudden, look at what happened at the far right of the chart. The U.S. took off. So the U.S. market, the S&P 500, for example, has moved up a lot relative to the EWY, which is a surrogate for the South Korean market. Wow, interesting, isn't it? Many of them have done this, but South Korea is the one that has had the most consistent underperformance, or to say it the other way, the U.S. has had the most consistent outperformance of the South compared to the South Korean market, and then with this taking off. Now, there are people who will see this as this is an indicator that of strength, and it may be. There are other people who will see this as this is way above the norm and it needs to correct, and they would even, quote, bet against that. Okay, gold and silver. Since the election, gold is a defensive asset, and since the election, there is less concern, less fear of the economy and of the dollar and the equity indexes, and you've seen this in data I've shown you, and that is showing up with gold going down and silver going down. Not a huge amount, but definitely a correction. So gold is down to $25.67 per ounce on the spot price. Silver, $30.27. One down 4.5, the other down 3.4 from the previous week. Now this is data based on Friday, and this last Friday, and compared to the previous Friday. The gold-silver ratio is 85-1. When you look at a monster box of silver, generic silver, bullion, rounds of silver, pure silver, 0.999% silver, a monster box of 500 of them is 15,000, as of last Friday, 15,785, and that includes $1.30 per ounce over spot markup, which brings the spot price up to 31.50. The spot price plus the $1.30 brings the retail price up to 31.57. Times 500. Times 500 is 15,785. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. Next week I will be traveling on vacation for Thanksgiving, but I will attempt to do a video next week and broadcast it from a remote location. Thank you.